So yesterday, the Federal Reserve cut interest rates for the first time in 4 years. And the Bank of England kept the central rate same at 5% compared to the last month. Now the next update is due on the 7th of November, and as you can see, the current inflation rate that the Bank of England claims is 2.2%, which is pretty much on its target for 2%. Nevertheless, easy access savings accounts such as CHIP, who advertise themselves as having, really high bank beating interest, have been very quick to drop interest rates well below the Bank of England's actual central rate. You can see here CHIP, which I've used over the year quite extensively. As you can see, I've had thousands of pounds in here. And the thing I like about this is that it is instant access, which you really can't beat too often. However, it has dropped its rates all the way down to 4.01%, and it's no longer competitive at all because even my Santander instant access savings account beats it, which is at 4.2%. Now, the thing that boggles my mind the most is that Trading 212 currently on uninvested cash are giving out a rate of 5.1%, which is 0.1% higher than the Bank of England's central rate. And it feels like I keep making videos on this because we're getting whiplash from Trading 212 cutting rates, then increasing it, and then increasing it further. However, I can never complain about higher interest, which is always better for the consumer. Now, if you want to sign up to Trading 212 and receive a free fractional share worth up to £100, then all you have to do is to click the link in the description box down below. Alternatively, if you've signed up less than 10 days ago and haven't received a free share, all you have to do is to click the 3 horizontal line menu here, scroll all the way down until you see the use promo code section here, and then enter the code JUBAIR here, and you should receive a free share. Of course, terms and conditions do apply. Now, currently the 5.1% that Trading 212 gives is bank beating, and I will just prove it now with the Money Saving Expert website. As you can see, you can go on and compare things yourself. So one of the highest here at 5.2% is from Ulster Bank. However, there are a lot of terms and conditions. For example, you must open the current account and then get the savings account from them. But most importantly, there is a minimum of £5,000 that you need to deposit first. You can also get 4.58% from Cahoots. However, not only is this lower than 5.1%, but this only lasts 1 year, which actually could be quite a good deal because I don't think Trading 212 can continue to pay 5.1%. But anyway, as you can see, headline amounts are just one thing. There are always terms and conditions. But the offering from Trading 212 is basically the highest amount you can get pretty much anywhere. There are also no balance limits, so even if you have £1 million stored here, I don't know why you would, in cash, but you will still be earning interest on that amount. There are also no withdrawal restrictions. I do have to note that, some people are under the impression that this is an instant access savings account, and it's not exactly instant. It's easy access, meaning you can withdraw whenever you want, penalty free. However, it will take at least 1 day for those funds to reach your bank account, so please do note that. And that is the other reason why I still use things like CHIP or Santander if you need the money instantaneously, if that's even a word. However, one of the greatest benefits of Trading 212 is that you do get paid out daily. Typically speaking, banks have always paid out annually, so the interest is calculated daily, but they pay out annually. I reckon this is a great way for them to, make more money out of the customer, because if they pay every year, they can use that money to invest in other products that they don't have to pay out every day. But anyway, Trading 212 pays out every single day. They calculate the yearly amount based on a per day basis, and then they will pay that amount to you around 10 p.m. every day. The other thing to note about Trading 212 is that there are 13 global currencies that you can earn interest from. Up until yesterday, you could earn 5% on US funds, for example, dollars. That rate cut would of course impact the interest rate you get on Trading 212 too. Now, one of the most common questions on gaining that 5.1% interest is, what is the catch? And the catch is, if you are in your invest account or your Trading 212 stocks ISA, the money that is gaining 5.1% interest is put into qualifying money market funds. This does not apply to the cash ISA. So if you have a cash ISA with Trading 212, you can keep receiving 5.1% as an annual equivalent rate paid out daily without worrying about your cash being protected. protected because the cash ISA is fully protected by the Financial Services Compensation Scheme. So in basic terms, the money that is earning interest outside of the cash ISA, let's say your stocks ISA or your invest account like I'm showing you here, this money at 5.1% is put into mostly qualifying money market funds, as you can see. But not just that, it is put into partner banks too, like JP Morgan, Barclays and NatWest. These are very, very high quality banks. So your money is spread out, and most of the time 100% of your money is not in qualifying money market funds. I will note that you do have to go in manually and opt in for this higher rate, and you have to accept the terms and conditions, in that there are some risks with qualifying money market funds. So first of all, what are qualifying money market funds? So essentially, qualifying money market funds are what they call open-ended investment funds. So these hold short-term debt issued by places very high quality, such as governments, banks, and other large corporations with very high credit ratings. Now, opposed to money market funds, which are also very safe in their own right, qualifying money market funds are required by regulations to maintain a very low risk strategy because they invest mostly in high quality things such as government bonds. Therefore, their regulation is much stricter than other things. However, there are four main risks with putting your money into qualifying money market funds. The first is the credit risk. This is when the cash put into qualifying money market funds becomes insolvent, which means that in a really bad case, you could lose some of your cash. Now, to mitigate this, Trading 212 only selects very high quality qualifying money market funds, and they also do monitor them frequently. The other is management risk. This is when you could potentially lose out money when the performance of the underlying qualifying money market funds perform bad because they are managed poorly. Again, Trading 212 safeguard you from this by choosing very high quality qualifying money market funds. The other risk is that interest rates could decline really quickly, leading to a reduction in the value of some of the bonds in the money market funds. However, Trading 212 selects qualifying money market funds with very short-term maturity bonds. That means very short-term bonds, they mature very quickly, so you really shouldn't be losing your money there. And the last one is liquidity risk. Under specific market conditions, you know, we have seen this before. Money market funds, qualifying money market funds too, can often not have liquidity. Liquidity basically means, you know, let's say you have £1 million of investment. However, it says £1 million on your screen, but when it comes to withdraw that, the actual fund provider doesn't have it, so there's no liquidity there. This can also sometimes happen to qualifying money market funds. However, Trading 212 makes sure that there is enough client money that is liquid so that they can process your withdrawals as soon as possible. So make sure to check out some of my other videos, and I'll see you in the next video.